Have you ever been in a situation where you're just sick and tired of investing in stocks because all you get are little to no returns from your investments? If your answer is yes, then you are in for a treat because you'll be hearing all sorts of advice from the veteran investor, Warren Buffett. What's good, you guys? This is Market Thrive, and today we're going to talk about how to properly manage your stock portfolio to maximize stock returns and boost your finances. Before we start the video, I would just like you to do me a favor by just hitting that subscribe button and the bell notification down below to keep you updated on this channel. So without further ado, let's hop into it. Let's first compare Warren Buffett's current portfolio to the number of equities he had during the start of his investing career. 11-year-old Warren Buffett made his first stock investment in 1941. For a total of $114.75, he purchased 3 preferred shares from a business called Cities Service. He very much went all in because his current net worth was only $120. There's not much diversity to discuss, but when Buffett was 19 years old, he would have a change of heart. He studied The Intelligent Investor at this time and then attended Columbia Business School to study value investing with Benjamin Graham. In 1951, Graham managed an investing partnership under the name of Graham-Newman, which had more than 100 distinct positions in its portfolio. Buffett decided that despite the portfolio's top-heavy nature, quote, maybe a single stock is too little, end quote, and increased his diversification to 7 holdings. He also made the decision to be top-heavy, much like Graham. In an interview, Buffett stated, quote, you will find opportunities that if you put 20% of your net worth in it, you've wasted the opportunity of a lifetime. You know, in terms of not really loading up, end quote. Buffett had just become a millionaire in January 1962 thanks to his own investing business, Buffett Partnerships Ltd. The positions of the partnership are not publicly disclosed. However, Buffett has provided some information on how his portfolio is divided. In 1962, he stated, quote, we usually have fairly large positions, 5% to 10% of our total assets in each of 5 or 6 generals, which was what Buffett called one type of investments in the partnership, with smaller positions in another 10 or 15. In 1966, he said, we probably have had only 5 or 6 situations in the 9-year history of the partnership where we have exceeded 25%. And also, we presently have 2 situations in the over 25% category, one a controlled company, which is Berkshire, and the other a large company, American Express, where we will never take an active part, end quote. I believe it is accurate to say from this that Buffett likes to maintain his focus at the time. We wouldn't see the same picture, though, if we skipped ahead to the present. More than 40 of the businesses owned by Warren Buffett are publicly traded, and he personally owns more than 50 additional businesses. Although it is challenging to describe his present portfolio because the majority of these companies are not publicly traded, I'll still try. According to my calculations, and you can find some assumptions in the description of the video, Warren Buffett's current portfolio looks like this. He's extremely top-heavy, but he's not as focused on a small number of businesses as he was in the past. Does this imply that Buffett now prefers a portfolio of 100 companies to one of 10 companies? That as he gets older and wiser, he no longer enjoys focusing on his portfolio? With the amount of wealth that Berkshire has, we will never have the opportunity to accomplish that. We make an effort to stock up. And there will be markets when we occasionally have the opportunity to acquire, but we hardly ever have the opportunity to purchase as much of any good notion as we would like to. So no, Buffett would adore managing a focused portfolio right now. It's only that when he exclusively considers the business world's elephants, he hardly ever discovers one of them to be both intelligible and discounted. However, you and I don't have to stop at elephants. So let's discuss 4 general guidelines that Warren Buffett would use to decide how many or how few stocks you ought to keep in your portfolio. By the way, the reasoning also holds true for other asset classes, such bonds or real estate. Are you a savvy investor? That is the first thing you should think about. Diversity offers a defense against ignorance. You own everything. After all, if you want to make sure that nothing negative occurs to you in regard to the market, there is nothing improper about that. That is, after all, a completely sensible strategy for someone who does not feel confident in their ability to examine businesses. It's definitely crazy to hold 50 stocks, 40 stocks, or 30 stocks if you know how to assess and value businesses. Brokerage firms are required to warn their clients that your capital is at risk. It is conceivable to roll a string of snake eyes since no company on the stock market is ever a sure bet. When investing, a savvy investor knows which dice he is rolling, or at the very least, knows what it looks like. The savvy investor has carried out actions like examined the financial records of the businesses he invests in, investigated the company's owners and management, recognizes who his primary rivals in the industries he competes in, and examines the cost of his investments in comparison to other stock market chances. Less diversification is required when your understanding of particular businesses increases. On the other hand, if you are unfamiliar with these aspects of companies, it is best to buy a variety of assets, presumably through an index fund, since you honestly have no idea what sort of dice you are rolling. Keep in mind that this can change depending on the industry or the country. By the way, while you may be very educated about American stocks, you may not be as knowledgeable about Canadian stocks. The amount of time you spend each week researching stocks is a good indicator of how much you know, because introspection of this sort is very challenging to attain. The best investment for those who cannot devote a lot of time to securities investigation is index funds. As Buffett said in 1993, quote, "By periodically investing in an index fund, for example, the know-nothing investor can actually outperform most investment professionals. Paradoxically, when dumb money acknowledges its limitations, it ceases to be dumb," end quote. This leads to the following question: do you invest in hazardous securities? It's crucial to have a diversity of bets, even at the roulette tables, where the casino has an edge that can be measured scientifically. There is hence a cap on the amount you can wager there. Casinos are aware that repeated losses can result in bankruptcy, and that no amount of prior overdue profits can make up for them. You'll need more diversification the riskier the bets you're placing. Obviously, the stock market is less definable than a casino. What you need to be on the lookout for in terms of riskiness are securities where, if you are wrong, you are probably going to lose everything in that holding. Here are a few instances of these: startups, cases of bankruptcy, industries that are in constant flux, and basically anything that involves leverage. Additionally, keep an eye out for relationships among your holdings. For instance, even if you had 20 separate horse carriage companies in your portfolio and the Ford Model T came along, your diversity wouldn't have done you any good because you would have been burned anyhow. So some people ask if some opportunities are significantly superior to others. Well, if you are a savvy investor, you ought to be able to assess the allure of specific prospects. If not universally, then at least within your sphere of expertise. Let's take an example where you've located companies that you believe will return the following. It would make sense to stock up on your top 5 suggestions in this situation. Your portfolio's predicted returns would decrease if you add an equal investment to firms 6 through 10, and you will be, as was alluded to at the beginning of the film, diversifying, to use a term from Peter Lynch. Additionally, you ought to spend far more money on your top idea than on the others. Similar to what Buffett accomplished with Apple and BNSF in the present, or what he did with Geico in 1951. Now, let's talk about how to earn it back. The fourth piece of advice is that you need fewer stocks the less capital you have to work with. The answer is based on your financial situation and where you are in your investment career. If you only have 1 month's salary to invest, for instance, you could lose your mind and wager the entire sum on one stock. Heck, I wouldn't even mind if you said you'd wager the entire sum at the roulette table, although that is a stupid idea, as long as you get your money back the following month. But you really need to start to think about diversification when we start talking about amounts of money that will take a few years to recover through your regular work. An extreme situation would be if you had recently inherited a sizable lump of cash. Okay, so if any of the following apply, you should focus more on your portfolio. You are a savvy investor who purchases assets with minimal risk of negative outcomes, expects a wide range of returns from the opportunities you've identified, and has the ability to replenish lost capital reasonably rapidly through income. It should be obvious that this is not an exact science, but when an investor is conscious of the route his mental process is taking, he will be at great advantage. So, thinking about managing your own portfolio and study the companies you wish to invest in? Who knows? Maybe you can be the next Warren Buffett. Feel free to jot down your thoughts in the comment section below. If you enjoyed today's video, please leave a like. And if you want to stay updated on our posts, hit that subscribe button as well. Once again, this is Market Thrive signing off.